Welcome to Remarkable Retail Podcast, episode number 301. I'm Michael LeBlanc.
And I'm Steve Dennis.
In this episode, we're going to delve into what Steve calls retail's great concentration, reflecting on the past decade in retail's evolution, how we got where we are today, and how death in the middle, the distraction of averages, superscalers, and how retailers still have time, but not much time, to still win. First, we'll be diving into the news of the week, including results from Tapestry, Warby Parker, and what just could be an early but strong contender for the dumbest retail story of the year. After our discussion together about retail's great concentration, we'll be back with a bit more news and then what's on our respective radar screens. Well, Steve, we are still basking in the glow of accolades after our 300th anniversary release last week with our guest Pete Nordstrom. He had nice things to say about our interview, but no rest for the wicked. While I was just hitting refresh on the LinkedIn, you were busy on your Pardon the Disruption Substack, actually reflecting on what you learned in 300 podcast episodes and interviews, retailer interviews. Give the people a quick overview.
We really, partially for time and partially because I hadn't given that much thought to it, we really didn't get into kind of the key takeaways of the past 5.5 years, 300 episodes, 12 seasons, whatever it is. And so I decided to put pen to paper, metaphorically, and share some of that in last week's Substack. There were several things that I got into, so I won't try to do all of it. The two I thought I would mention quickly was, one point I made was, and of course we've come back to this multiple times, is that the conventional wisdom is frequently wrong. When I thought about some of the things, not just on the podcast, definitely in some of my writing and other content, there have been a lot of these pretty hyperbolic narratives that develop that I think we have found ourselves challenging and coming back to. The one I've, of course, been banging the drum for a long time is that physical retail is dead, retail apocalypse kind of thing. But, you know, there was a period of time, as you will remember, where it was all about the metaverse and it was all about retail media networks. Now, I guess it's all about AI. But also these kind of hyperbolic statements around, you know, retail's all about convenience, all about seamless, all about frictionless. And then, of course, you can point to
stores
many
are
cases.
back.
Yeah, stores are back. The great e-commerce acceleration, DTC is the whole future, and, you know, on and on and on. And I think for sure there's often really useful things underneath this, or the truth is messier, I guess, maybe than just the high-level clickbait sort of headline. But, you know, with the passage of time, often facts come into play, which actually say, well, you know, maybe not so much, or maybe the nuance is not understood well enough. But, you know, rather than just kind of spike the football and do an I told you so thing, which I am prone to do.
Tempting as it is.
Tempting as it is. But the reason I care and the reason we talk about it, I think most of the time, is you can make some really bad decisions by buying into the narrative. So I was thinking about a couple of really good examples. There are many, many more. But if you look at the difference between what Walmart chose to do over the last few years, at one level at least, versus, say, Nike bought into the great acceleration narrative and was willing to give up some of their physical retail presence to chase e-commerce, which isn't the only DTC part of it, but a big piece of that. And that, among other things, has gotten them into a lot of trouble. Walmart, on the other hand, clearly invested a lot in digital, has grown their e-commerce very nicely, but they have also really focused on their stores and have been investing a lot in physical retail. And that is a key to their success. So if you bought into these very different perspectives, you could, in many cases, make a lot of mistakes. The other one I was thinking about is, say, Allbirds versus or Wayfair versus, say, an On Running or Levi's. So Allbirds and Wayfair, as we've talked about, really into digital, online, not really getting their mix of distribution more balanced. On Running, very big direct-to-consumer business, very big wholesale business, good blend of wholesale, their own stores, and online. Levi's, which is a little bit more recent story because they've been more of a turnaround rather than a big growth story, but same thing, investing very strategically in maintaining wholesale, but contracting a bit as they invest more in e-commerce and their own stores. So there's really a nuance to it rather than say, oh my God, everything's going direct to consumer or everything's going from physical online. That's why I said the other one I was just going to touch on briefly was this subheading, I guess, that I had in the Substack was the best leaders ask better questions. And when I reflected on some of our best guests, we've had many, and some of them were best for all sorts of different reasons. But I think a lot of the ones, particularly when we get people from publicly traded companies or maybe companies that are looking to raise a lot of capital that are still private, is the really interesting interviews are those where the CEO or founder is not just giving us the investor pitch or going to their CNBC kind of talking points, but they really push through what I've started to call the unholy trinity of where we get stuck, which is ego, ignorance, and fear, just to pull on some stuff I talk about in Leaders Leap, which is, they're very humble. I think about folks like Hal Lawton, James Daunt from Barnes & Noble, just last week, Pete Nordstrom from Nordstrom. There's a humility, there's a willingness to take risks or say, we don't really know how this is working. Like they don't present as if they have all the answers or their way is the only way to do things. And I think that's really rooted in asking questions as opposed to just kind of pushing their point of view on the market or on us. So anyway, there's just a couple quick reflections out of a few others in the piece that maybe people want to go check out.
And once again, that's Steve's Substack, Pardon the Disruption, available, in Substack. All right, let's get to the news of the week.
A store near you.
Let's get to the news of the week. A little more another batch of earnings. Let's kick it off with Tapestry.
Yeah, we're coming to the close to the tail end of the calendar year quarter. And then typically you get a little bit of a break, though everything seems to stretch out before we get a bunch of retailers that will be giving their results ending the month of April. So stay tuned for that in 2 or 3 weeks, I guess. But Tapestry, which is the parent company of Coach and Kate Spade, but I think Coach is like 83% or something of their total revenue, really, really, like in some respects to me, surprisingly amazing earnings report. Their revenue was up 21%. Now there's some new stores in there, but very much driven by Coach, which is a brand that has been around for a long time with a lot of distribution. Their revenues were up 31%. And actually the Kate Spade business, as I said, quite a bit smaller. I have some history with the Kate Spade business because we owned it when I was at Neiman Marcus. That's a business that's definitely been very much all over the place for 20, 25 years. Kate Spade's down 10%. So the star of the show is really Coach. Profits up nearly 70%. So if you go to, a little bit of this is Tapestry's still sort of kind of a turnaround. They had some rough periods going back a little while. So they are comparing to some somewhat easier numbers, but that is just tremendous growth. And I guess I would say two things, kind of takeaways. One is they are a great example of a company that has really gone from their wholesale roots, overwhelmingly wholesale, going back 15 or 20 years. They are now close to 90% of their business is direct to consumer. Now, it's mostly their own stores, but also a really good e-commerce business. Some of our listeners may recall we talked to one of their customer insight folks and one of their consultants last year about how they are leveraging customer insight to inform their branding strategies, their product strategies, their targeted marketing strategies. And one of the things that they've talked a lot about is how much that has really helped them get greater focus, evolve their product assortment, even get that channel input or that channel mix more clear. So it's super impressive, and I think that is really a brand that, like I say, is pretty much a legacy brand. It's been around for a while that seems to be able to do some new things, and they're clearly gaining significant market share over the last year or so.
Well, when I read the results, I reflected exactly as you said on the interview we had last summer at Commerce Next, and the level of sophistication and strategic thinking about the marketing plan and program was really illustrative of what it's going to take to succeed. So it came as no surprise to me. In fact, it was nice to validate that, all that hard work and thinking actually works. It actually can produce real numbers. Let's talk about Warby Parker. We're a fan. We've had Neil Blumenthal on the pod before. Good numbers.
Yeah, I want to kind of put Warby Parker in perspective. A couple of reasons why I decided to focus on this, because obviously there's lots of earnings reports we could talk about. Some of this is, yes, we're a fan of the brand. Some of this is we've touched on their both their challenges and some of the pivots they have been making over the last few years to get on a better path. But they are definitely, as much as we talk about some of these disruptor brands that have gotten into a lot of trouble, Warby Parker is among a handful of these really kind of second generation digitally native vertical brands, or whatever you want to call them, that has been able to demonstrate profitable growth, continues to open stores as opposed to doing Allbirds or a Glossier have been pulling back. So specifically their net revenues were up 8.3%. So that's a mix of decent comp store growth, plus I think 15 new stores in the quarter. Their active customer base is up about 5%. So most of their customer metrics have been pretty good and very solid with good momentum for a while now. But I would say overall, given where they are in their evolution, given all the new stores they have, I think the revenue is a little underwhelming. I mean, they're definitely taking market share, but their growth is slowing, and they've got a little bit of margin pressure from tariffs. So good, but not great report. I think the thing to watch here, not just for Warby Parker, but maybe what this says more broadly is the slowing of growth, discretionary spending impact, because people need glasses, but there's kind of a fashion business. So sometimes a lot of their sales they talk about being people getting multiple pairs as more a fashion statement, or the replacement cycle goes up more because of their affordability. But, maybe also given their niche position, which is one of the things I love about them, very focused, taking kind of a boring category and really revolutionizing it in a lot of respects. Is the upside to that part of the market. Are they starting to push up against some of the marginal growth pressures? But they're still planning to open dozens of stores each year. So I don't think there's any suggestion that they're planning to slow down. But I would say the somewhat lackluster growth, given their store growth, is maybe something to look at. And I guess just also put it in perspective, this is still a business as much. I mean, they kind of punch above their weight because they get a lot of attention, not just from us, but from Wall Street and the retail industry more broadly for many good reasons. But it's still a business that's significantly under $1 billion. So in the scheme of things, this is not a huge business, even when you talk about other specialty retailers, not comparing them to Amazon or Walmart. They're obviously way, way, way smaller and will never be that big.
So I guess if you're a meme stock CEO, you can't go invade somebody or build a big monument or something. You got to go make a wild ass offer that gets you into the news and time it so that it hits the news cycle on Monday morning. Let's talk about GameStop and eBay.
Yeah. So as you teased at the top, perhaps the dumbest story of the year, definitely the dumbest story to date. And I'm going to say it's a little bit hard to imagine what's going to be dumber than GameStop's bid for eBay. Now, I imagine at this point, a lot of people have heard about it, but just in case you haven't, a little bit of kind of just the facts, ma'am. GameStop has offered $56 billion for eBay. Now, a couple things just to put this in perspective. GameStop's revenues are about $3.5 billion. eBay's revenues are $11 billion. So this is a David and Goliath story on a revenue basis, but also probably more pertinently for trying to do a takeover. GameStop is worth, its market value is $11 billion. $11 billion company trying to take over a $56 billion company. GameStop only has $9 billion in cash. I say only, that's a lot of cash, but relative to trying to buy something for $56 billion, and has lined up $20 billion in debt. So they have identified $29 billion in cash to make a $56 billion acquisition. Now, I'm not that great at math, but I'm pretty sure 29 is less than 56 by a pretty good amount. The other thing that I think is kind of crazy is when they announced this offer, part of the strategic rationale was that the combination of GameStop and eBay could be a serious rival to Amazon, which to me at face value is devoid of reality.
Yeah.
But wait, there's more, because the other thing, aside from just when I read the story, I was like, well, that's not going to happen. And a lot of people were skeptical of it. So Ryan, their CEO, GameStop CEO, who is also the founder of Chewy, by the way. He went on CNBC, and I would just say, people who haven't seen the video, I'm not going to try to give an explanation of it, but it was among the worst appearance I've ever seen by a CEO on CNBC, because it was very weird in general. His whole vibe was quite strange. He said a lot of nonsensical things. And when he got skeptical questions from Adam Ross Sorkin, as well as the rest of Becky Quick and some others, let's just see, he didn't handle the questions super well. I think if you're the PR firm for GameStop, you probably, or investor relations, you probably needed to have a little chat with him afterwards. But anyway, GameStop, as some people would know, has mostly been a meme stock for the past few years. And while their profits have improved a little bit, their revenues are going the opposite direction. They've been closing stores. They don't seem to have any real forward momentum as to how to improve the GameStop business. So I think this is, I don't know what it is really. Hail Mary is probably the most charitable thing you could say, but yeah, it is quite hard to understand. So anyway, I also wrote a little bit about this on my Substack. So if you want a little bit more on it, mostly my cheeky commentary, go check that out.
It's hard to avoid. On the positive side, when's the last time we said the words eBay in a sentence, even on this podcast?
There you
I've
go.
been thinking about eBay for a long time. Maybe we should pay more attention to what's going on over at eBay. You know, $50 billion company. We probably should pay a bit more attention.
They are. I mean, they are kind of sleepy at this point. Yeah, they don't get a lot of news, but yeah, $11 billion, not nothing, and they continue to grow though, kind of slowly. So yeah, maybe this will shine some. They probably wanted attention for different reasons.
All right, that's a wrap on the first part of the news. We'll be back talking about Saks Global getting ready for their comeback, a bit of news on Anthropic, and then, of course, what's on our radar screens. Let's jump now into our segment talking about retail's great concentration. And, you know, I was reflecting on this and thinking back a couple of weeks ago. I did a keynote at Google headquarters here in Toronto, and I do borrow shamelessly with accreditation some of your concepts, everything from, you know, this don't pay attention to the averages, look at the concentration that's happening with shopping versus buying, and this kind of death in the middle. I use Hudson's Bay as the perfect example of, you know, here's what happens if you do that. And, you know, just the audience, I got great feedback. So these concepts have been around for a while, many, many years, but they still really reverberate with very, you know, these people work in the retail sector all the time. So I'm looking forward to this kind of refresh of how you're thinking about it currently. I don't know if refresh is the right word, but what are your latest thoughts and, I guess, proof points? And let's get into it.
Yeah, so, you know, we got to have a great something or other, seems all the time. Great bifurcation, great concentration, you know, whatever, great acceleration. But this thing I'm calling the great concentration is really about, maybe it's obvious, more and more market share is being concentrated in a very short list of a few powerful players, hyperscalers, whatever you want to call them. Now, we have touched on this here and there over the last several years, but I thought maybe go a little bit deeper on this. What prompted me to think about it this particular week was really a confluence of things over the last week or so, which was we already talked about Amazon's earnings, I guess, last week. And one of the things that if folks listen to that episode, they might recall is we talked about, first of all, that Amazon's retail business continues to grow much faster than the average. Their GMV probably, I mean, it's an estimate since they don't report that separately, growing at around 9% for the last little bit, which is a good 2 times the industry average. But the thing we really pointed out is, and not only is that better than industry growth, but it is on a massive base. Some folks may remember that Costco, which is the number 3 retailer in the world, number 3 retailer in North America and the US, Costco reports monthly sales. And so last week they did their sales release for the month of April. Their sales growth was 8%. So also well above average. That, by the way, they report it with gasoline and without gasoline. That is the number without gasoline. The number was over 10% if you include their fuel business. So again, huge base, way above average. And then our friends at Placer also released a study about the growing concentration of visits to stores being concentrated among some of the top players, so Walmart, Costco, but also dollar stores like Dollar General, where there has been since COVID, there has been a steady increase in store traffic, faster than average store traffic growth among these bigger players as well. It's clear that this is going on. Now, I guess just stepping back for a second, I've been trying to look at some of these macro trends for a long time, going back 10, 12 years when I started talking about death in the middle, that where there was really problems emerging both in sales growth, profit growth, as well as the concentration of store closings was among these groups in what have come to call the unremarkable middle. So we're seeing a lot of growth on the value end, convenience, price, whatever, a lot of growth on the higher end specialty, right? So that was one thing. That led me to get into this great retail bifurcation, which is really kind of the same idea, just kind of updated. The other thing you and I have talked about, and I kind of unpacked, I guess, a little bit in my first book, is you can also look at this bifurcation and this concentration as what I call the difference between buying versus shopping. So buying being more errands, efficiency, convenience dominated, whereas shopping is more discovery, emotional, brand elevation, that kind of side of the thing. Now, it's not that black and white.
Looking for inspiration.
But, when you think about it, and I've got more to say on that in the future, but anyway, just kind of put that out there. So one of the things I was thinking about as we see kind of this fork in the road with the buying growing very quickly and then the more elevated kind of branding specialty high-end growing, and then the middle being kind of no man's land that is collapsing more and more, is as price has become more important kind of in general because of the dynamics of the way the retail industry has evolved, but also because of all the pressures from the economy, we are seeing this buying, this price side grow faster. You could certainly make an argument that AI, agentic AI, and the ability to get prices and kind of go out and find the lowest price will probably push that even more. So I think we're seeing some macro forces that are causing this split to be more pronounced, but also probably pushing to the more value side. And so if you are Amazon or Costco or TJ Maxx or any value-oriented retailer, not only are you got a great business model and executing well, but there are factors that work in your favor. Just to mention a quick piece of data, which I know we've touched on before, the latest data that I've seen, will update this, I'm sure. Actually, our friend Jason Goldberg will probably update this once we get Walmart and Costco's quarterly earnings next month or later in the month maybe, is that 6 retailers in the U.S. are capturing over 60% of all the industry's incremental growth. So it's one thing to look at the market share, but what's happening at the margins is even more pronounced. And I think that also, though I haven't seen anybody try to figure this out, because of how profitable Walmart and Amazon and Costco are, it's probably even more pronounced if you were to look at share of profitability, if only because Amazon and Walmart also have this advertising business, which really boosts their margin. I think, I guess the last thing I'd say sort of big picture is I'm not sure what's going to slow that down anytime soon. Like the momentum seems to be so strong in the favor of these guys with great business models, executing well, enormous scale. You think about what kind of investments Walmart and Amazon are making in last mile delivery and their ability to keep upping the amount of products that are available same day, next day, in an hour or two. So I think there's so much momentum. So I don't think there's any sign of this really slowing. So, okay, so what? I think one is, and you teased this a little bit, it is important to keep in mind when we hear the retail continues to grow quickly, the consumer is resilient, those kinds of things. Well, not really unless you're one of these 6, 7, 8 retailers that are capturing overwhelmingly the disproportionate share of growth. So the implication for most people is, well, actually, and we mentioned a few like Tapestry and others that are getting this above average growth, but by number, most retailers are not experiencing growth, or their growth is well below the rate of inflation. And with costs going up, there's this profit squeeze. So I think if you step back and look at the health of retail overall, the narrative is not quite so rosy. And of course, the tyranny of the averages is nobody really experiences the average. I mean, if anybody does, it's Walmart and Amazon because they're so massive. But, if you're Kroger, or if you're some specialty retailer or whatever, like, it's not that interesting what's happening overall. The question is for your customers, for your competitors, for your sector, what's going on? And I think generally speaking, it's not that great. And as more things move towards value, sort of these gravitational pulls towards lower price, more convenience, can you really keep up with that? What aspect is really table stakes versus differentiation, as we often come back to? Yep. How much of these trends can you kind of rent versus buy? Because if you're going to try to out Amazon or Walmart on investment and staying at the leading edge, I mean, that is just, even if you're a pretty good sized retailer, and I'll talk about this a little bit when we talk about Saks Global, but it's just so daunting. So a couple just kind of takeaways and then we can move ahead for now. But I think one is, really get into the data that's relevant for you and not get caught up in big, broad macro kinds of things, because in most cases, that's not your situation. Accept the reality of your situation and then act on the things you can control. I think it's also understand what race you're running, because, the cliche we come back to a lot is Seth Godin's comment about the problem with the race to the bottom is you might win or worse, finish second. And I do think there are a lot of companies that don't really understand what race they're playing, and you don't want to engage in a race that you can't realistically win or at least be in the competitive mix. And this comes back just quickly a little bit, and I'll have more on this as we go forward because I'm doing a bunch of work on this, but it is also understanding, I think, this buying versus shopping potential dichotomy, because if it's all about price, convenience, et cetera, most folks are not going to be able to win that race. When it comes to AI, for example, obviously AI is transformative. I think there's very few businesses that should not have a big investment in AI, but don't lose sight of where your brand value comes from. Because if your brand value is going to come from differentiating on things that are more experiential, tactile, physical stores, you could, as we've seen with many retailers, disinvest in those areas where you might have a real opportunity to be different than trying to chase Amazon and Walmart and beat them at their own game. So I think if you think about what the consumer is trying to accomplish, if they're trying to accomplish the lowest price, fastest way to get something done, that's a very different problem to solve for than customers that are really trying to find a sense of meaning or belonging or difference, be with their tribes, have that social connection, in a world that's moving much more towards isolation and tech heavy. So I think there's just an aspect of getting it, more clarity around that and not just being kind of carried around along with the like all things AI. Well, sure, AI is huge, but where's the human dimension? More on that, but I'm just noticing that there seems to be this gravitational pull towards sort of all things technology, and some companies are definitely paying attention more to the human side of it. But I think overall, not enough are paying attention to it, and too many are going to be chasing their tail, trying to shorten delivery times and put as much as they can into the hands of robots, when maybe some of that needs to be kept in the hands of real people, complemented by technology, driven by technology, but not leading with them. So thanks for coming to my TED Talk.
Well, it's a lot to think about. And as I was listening to you, I was thinking about this kind of phrase that was resonating in my head, ain't nothing going to stop us now if you're a super scaler, right? And I can't imagine anyone at Amazon or Walmart is sitting in an office going, we're done. Like nobody's ever going to catch us. Because what are your thoughts around these, disruptive models that come forward? We've seen them in the history of retail. Walmart supersedes A&P and Amazon supersedes and comes out. You had Shein and Temu and TikTok shops. Like, and I remember at Shop Talk this year, we heard this organization that's harnessing all the different couriers together to do same day, what they called Amazon for the rest of us kind of thing. So is it a disruptive model that is going to change this? I mean, I think some people are counting on AI to be the big disruptor. I don't think it is either. But in your mind, what's the, short of a pandemic, what's the, what's the broomstick in the bicycle spoke of these big players that will kind of send them sideways? A couple of big mistakes, hard to imagine, but they must be. I'm sure if you were sitting in their chair, as you were at Sears, you're thinking like, it's not going to last forever. It feels like it, right? But boy, we don't want to be sitting here thinking that's going to happen. What could happen? What do you imagine that could happen?
Well, I do think some things are fundamentally different in that, it's a much more digitally driven world. So that allows things to scale and be dispersed much more quickly. So that's a pretty big difference, back to the Sears versus Walmart versus whomever days. It's hard for me to imagine right now that anybody is going to meaningfully beat Amazon and Walmart or Costco at their own game. So I do think it is something that is fundamentally disruptive. And you can imagine agentic AI or aspects of agentic AI changing this disintermediation idea, is our brands, vendor brands with a direct to consumer model that leverage their market power to kind of cut out the middleman. Is that going to be a real headwind for the multi-line guys, whether it's the huge guys or smaller guys?
Sure.
I think that's plausible. I don't think that's going to happen super quickly, but that's a thing I think you can imagine. I think what typically happens with the very large brands, and Warby Parker is kind of a good example of this, just to use an example of somebody we talked about recently, is people find vulnerabilities in the big guys that are trying to be a little bit of everything to everybody. So they're not going head on, but they're picking out 2% of their customer base or 5% of their customer base and saying, okay, if we understand these customers, whether that's based on more fashion or different price point or whatever, and we're really going to go after that. And that's always been the thing that great especially retailers have done, right? Like that's not a new concept fundamentally. I think what's different is how you might use technology to do it in a way that you couldn't do. Because, the old time specialty retailer was you're opening a store and you had e-commerce, but it's mostly about a store. Now being digitally led, you can test those things faster. You can maybe change the underlying economics of doing it. It's much less capital intensive. So I would never say never that these guys can't be slowed down or disrupted in a fundamental way. But I think most of the action, at least for the foreseeable future, is going to be outside of the really, really big guys. It's going to be on that other 70% or whatever of the pie where you have companies that are mediocre, not moving fast enough, and kind of leave open. Like Nike is actually an example, right? How is it that On Running and Hoka were able to grow so quickly? Yes, some of it is the thing we talked about at the top, which was the correction or whatever to DTC, but it was also product innovation, and it was also not understanding the different customer types well enough and kind of spreading the peanut butter too thin, so to speak, that created an opening. So I think that's the kind of thing that happens. I think it remains to be seen the degree to which AI will really be the accelerant there, but that would be my bet. I mean, that's going to allow people to test things, do things differently, and not have the same kind of scale.
Yeah. I think of it like a Shopify that leveled the playing field so that the small player could have don't have to worry about taking credit cards and all that stuff. I see AI as a platform that's a leveler. So there's capability for that. I love your idea. Just, the interesting things are happening on, so to speak, on the margins. I think of Tecovas, right? He's building a business. Yeah. It's not a massive business, but they're making money. They're building a business. They're doing interesting things, but they got nothing to do with either Walmart or Amazon or Costco, right?
And I think on that, Tecovas, we've had a bunch of these brands on that are small, not for everybody, not trying to be for everybody, but, they take a toll on certain players, right? Because there's a little bit death by 1,000 cuts, or, the mosquito brand is one of my clients used to call it. Yeah. So there's a lot of metaphors for that. But, a lot of times the Tecovas's of the Vioris, they're not taking their business away from Amazon and Walmart or Costco, right? They're taking it away from department stores. They're taking it away from, or other people that are like the traditional legacy players in that in that area. It can be meaningful to the folks they're really taking the share from. But yeah, in aggregate, it's not massive.
All right. Well, lots more to say about that, I'm sure, as these concepts evolve, both in your noggin and as our environment evolves and as the year progresses. Let's get on to the part 2 of our news, and let's talk about Saks Global. There seems to be some optimism coming out from their team about getting back on track and ready to go. But do you share their optimism?
Well, in some respects, I do. I mean, we've talked about this a few times. I think the last time we talked about them was in the context of some of their store closings and also looking like they might be able to exit bankruptcy in the summer. It now looks like that is perhaps just a few weeks away and actually would be technically late spring. Geoffroy van Ramdonk, the CEO, has actually did a bunch of press last week to, I think, share a lot of what was going on and try to get the story, I guess, shifted back to, hey, we're
plow the road.
We're back in business. But anyway, just kind of quickly, some of the specific pieces of news. It looks like they have lined up the financing they need to exit bankruptcy and have certain agreements either in place or more or less an understanding of what they need to do to get the creditors and the court to sign off. And so Geoffroy indicated it looked like that would happen the first week, towards the end of the first week or second week of June. So that's right around the corner. He also quoted some statistics about inventory, as folks would know or heard us talk about. Part of the big issue, because of all the cash flow issues they had before they went into Chapter 11, was they couldn't get any product or had very little product. Well, he said that all their orders have been fulfilled and they're in a dramatically better place. He also shared some data about getting current or more current with a number of their vendors. He's clearly been working on trying to improve the vendor relationships, which really went to, I believe the technical term is to shit, towards the end of last year. You know, as they've shared more detail, and of course we talked about this a little bit, but through their store closings, through having, I think what they're indicating is about $1 billion in debt, which is like, I think before Saks Global was at $4 billion or something north of that. So a much more viable balance sheet, much more workable store portfolio, both in terms of the general quality, but because they closed some overlapping locations, that will funnel some of their business, give them much better four-wall economics. So this is very positive. Now, the bad news, or at least the questions are, I still believe they are overspaced or overdeployed on the physical side. And I mean, I still believe there are some stores that need to close, whether that will happen quickly or over the passage of time. But of course, when you're in bankruptcy, that's the best time to try to get out of those leases. So maybe there'll be some more, well, maybe I'm wrong about that. Maybe there'll be some news on that. Maybe there's some things that have been worked out. But the bigger one, and I'll tie this to one other comment I have about something that Geoffroy said in the press, but I will say, because I may have shared on the podcast that he and I sat on a plane together a couple of years back and had this conversation. Yeah. But I still think most of the stores are way too large for the business they need to do. And, you know, the rent is the rent. But in terms of the shopping experience, these 3-level stores that are vast, I think it's really hard to make that feel like a very elevated, focused experience, aside from just, you know, you got to have staff, you got to have inventory, et cetera. But I would tie that specifically to one of the things he said, which he's said in the past, was that they really want to narrow their focus on the very, very best customers. This has been a thing that Neiman's and Saks have thrown around for a while, the statistics about what % of their business comes from customers, these high-spending customers. Particular thing he said, which is not terribly different, I don't think, from when I was there, is about 40% of the business comes from customers that spend over $36,000 a year. We used to code 25,000. Some of that's inflation. And the benefit of that is, you know, having a really distinctive position that's different than Bloomingdale's and Nordstrom's, et cetera. Some of that is they're a full price customer. Some of that is your brand positioning. But what it ignores, or is in danger of ignoring, is the other 60%. And the other 60% is 3/4 of the space in these stores. And I know from dealing with these customers that a lot of the high-end customers buy very little of the same stuff that the other 60% do. And a lot of that product that the other customers buy is more widely distributed. So on the one hand, you could argue, well, let's de-emphasize that because we're not as differentiated. But when you have a $200 million store, for example, which is probably about the volume at the North Park store here in Dallas, the Beverly Hills store, it's really hard to get the numbers to work out because the more you focus on that high-end customer, I'm not sure that really high-end customer wants to shop in this vast store. And they have lots of places to go as well, which gets me to my last point, which we've talked about, which is the competition from vendors.
The brands. Yeah.
And one of the things that has happened by virtue of closing these stores is more of your stores are exposed to markets where those vendors have a lot of presence and tend to be growing. I believe they're in better inventory position. They've gotten rid of a lot of the distraction. So it's a much more focused, much more profitable business. Whether they have any capacity to really grow in a meaningful way in light of the competition from vendors, in light of some of the other dynamics in the business, highly questionable to me. And also, which I'll tie back to what we were saying earlier, Neiman's needs to put a bunch of capital into the business. There's stores that, like I say, I think they need to be downsized or at least respaced, but they need to be updated. But they also need to invest a lot of money in technology. And so will they have the cash flow? I mean, I'm not worried about like the next 12 months, but over the passage of time, will they have enough money to make the investments they need to just to stay current? But if they're really going to be a growth vehicle, they're going to have to do some different things. They'll get a lift from being back in business with inventory and not being so spread thin. But anyway, I think it's not a slam dunk that they will be able to grow this business. I think they will be in a place where they're out of desperate struggles for sure for at least a period of time.
Maybe a period of more profitability, but as you say, it's hard to imagine growth. Maybe just a more stable, profitable business would be a pretty good short-term objective for the team coming out of bankruptcy. So you, like me, experiment and use all the different platforms, AI platforms, whether it's Anthropic or ChatGPT or Gemini. Use them all for different things. But boy, I've watched the Anthropic demand, and maybe it's Scott Galloway's push to streamline what you're using on his push. Maybe it's because they've just introduced a more powerful model that seems to rotate. What the numbers they're putting out, use numbers, are incredible.
So their CEO did an interview last week where he said their demand year over year for Claude is up 80 times. And I was like, 8 times? 80 times.
80.
Now, again, relatively small base, but quite extraordinary. And the other thing that has been rumored is that they may have a valuation that will surpass $1 trillion. Now, folks that are familiar with these numbers will know very few companies have over $1 trillion. So in general, that's an extraordinary thing for any company to get to ever, but particularly a company that's only a few years old. So anyway, more to come on that, but it is mind-boggling, really.
Let's move to what's on the radar screen. What are you thinking about?
What I got on my radar screen is maybe a little bit of a micro story, but it does, I think, have a retail connection. So I've seen a couple stories about the lackluster demand for the World Cup, which is coming up here in North America. And there's really 2 things. One has been slow ticket sales, maybe 3 things. Slow ticket sales. Second thing is complaints, which may be related, about the prices of the tickets. And then the third, which was really the things that prompted me to add it, is also really lackluster hotel bookings. There were a number of stories I saw about how several of the cities, including Dallas, which is one of the host cities, are seeing hotel bookings well below, hotel bookings, Airbnb, Vrbo bookings, well below what folks were hoping for. And actually, in a little bit of an ironic twist, some hotel folks have been saying that their bookings were running lower because they think people the prices were high. So people were avoiding booking in certain places because they wanted to steer clear of the World Cup craziness and elevated prices. Yeah. And so things are actually below where they would normally be if the World Cup wasn't going to be here. Now we still have, I guess a month or so before things get kicked off. But of course, this is a general issue, but you would imagine that all these travelers to the various host cities would be spending money in restaurants, spending money in retail. So I do know of some retailers here in the Dallas area that have been talking about some special things they were going to do to take advantage of the World Cup crowds. Mm-hmm. And maybe the World Cup crowds aren't going to be so crowd-like.
Well, in the world of great minds think alike, I'm also thinking about the World Cup because it's playing here in Toronto and in Vancouver. Just a huge event here. There's no talk about people not coming to Toronto or Vancouver. The talk is, it continues to be in general, and you touched on it a little bit, this whole algorithms and pricing, surveillance pricing. And if you're looking for a villain in that, that's FIFA, who is, what the market will bear, charging thousands and thousands of dollars. And I don't know, FIFA says, well, we're going to take all that money, we're going to reinvest it in, maybe they're going to join the Board of Peace or something for $1 billion. The Board of Peace seems to be Board of Peace. Yeah, maybe a host of statues. Anyway, we're expecting in Toronto just traffic mayhem, the beautiful game, lots of activities. Of course, the bars are banned from saying that they're showing a World Cup game. And there's 132 inspectors in Toronto visiting bars to make sure that this is. So I did some searching on what bars are calling it. Summer of Soccer, International Match Nights. Watch the world play here. And it does, we don't talk about indie retailers like one or two stores very much. It's not really our jam, as Carl Boutte would say. But the power of sports, help this indie retailers in Montreal. Montreal's playing Buffalo in the NHL. And I was in Montreal last week, and the small vendors of Montreal Canadiens gear are just flying. I mean, it makes their year. It makes many, many years. So anyway, shout out, by the way, as we wrap the episode, to Scott Wingo, prior guest on the show, we're a fan of Scott's, on raising $13 million for his latest venture, Refi Buy. I would point out to Scott that startups typically spend between 10 and 20% on marketing. So we'd be happy to take $1.3 million or $2.6 million for the Remarkable Retail podcast. Make sure everybody knows about Refi Buy. So, Scott, if you're listening, our phone lines are open.
It could be like the Refi Buy Crypto.com Remarkable Retail podcast.
Exactly. We're up for the challenge. Anyway, congratulations, as comics in all seriousness. Congratulations, Scott, on yet another great venture. All right. That's a wrap on this episode.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to stephenpdennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.